Thanks for joining us. My name is Tanya Krug, Head of Investor Relations from Pelorus. I have Rob Sechrist and his managing partner, Travis Goad, and I'd like to welcome them.
Thanks, Tanya. We appreciate you kicking off the meeting for us. So I wanted to kind of walk through what today some of the topics we're going to talk about. We're going to give a high-level overview of what Pelorus does, what makes specialty use private mortgage REIT attractive when comparing to public equities, and why cannabis sector would be less impacted by a real estate or economic downturn. And we're going to give a legislative update as well, some things to talk about there, and how we compare to some of our lending peers in the space. So Travis, there, you're unmuted. So the first thing we'll start off with today is Travis, welcome. Happy to see you today over in New York. Did you survive for the flooding over there, or did that all passed?
Yeah, luckily, it was about 6 days of heavy rain. But where I'm at, we weren't that impacted by the flooding in Manhattan, but Brooklyn and some other areas had some really big issues. So luckily dodged the bulk of it.
Good, I'm glad. So maybe you could start off by just explaining to people that may not be familiar with what we do, give a high-level overview of Pelorus and what we do.
So Pelorus is the longest running and first dedicated lender to the cannabis sector. So we make first lien senior secured mortgage loans on cannabis use real estate. We'll do it in any legal market, but we do a mix of construction financing for when you need to build the facility, whether retrofitting an old facility or doing ground up construction. And when the construction is completed, we have a second loan product that is meant for cash flowing, what we deem stabilized lending loans.
Great. A lot of people ask, how did we get in this space? And I like to kind of give that background. So Pelorus was formed in 2010. And in 2014, our local Congressman Dana Rohrabacher, who we still have a great relationship with, passed the most consequential legislation to date, which was the Rohrabacher-Blumenauer Amendment at the time, which defunded the Department of Justice from any prosecution of a cannabis-related business in a medically licensed state. And I remember at the time, our other partner, Dan, wanted to enter this space. And I'm like, buddy, this is going to be a tough space to raise capital in. And it certainly was, but I'm glad we took that leap and we pivoted into this space. So maybe you could talk a little bit about what makes our specialty use private mortgage REIT attractive when compared to other public equities out there. Why alternatives so popular these days, and maybe dovetail in with our strategy specifically.
Sure. So private credit allocations have been one of the biggest investing landscape shifts in the last 15 years, ever since kind of the 2008 crisis. Ultimately, allocators, both institutional and retail allocators, made a decision that one, there's excess spread to be picked up through private credit by originating loans and lending directly to real estate or other private credit or takers of private credit. But two, it lacks the volatility that you see in kind of broader equity markets, et cetera, and so there's a chance for excess spread. It's a chance for uncorrelated returns. So returns that are not correlated to the day-to-day movements of public equities. And it's generally been an attractive sector. And so we've done, since inception, between 12 and 15% annualized IRRs, and most of which have been fully cash distributions on a monthly basis during quite a few different, public equities regimes. So it's it's diversification.
Yeah, maybe I'll take a step back for a second, because most people are familiar with the term REIT, and we are a REIT, but we're a mortgage REIT. Maybe we could just take a second to delineate the difference between those two, and why an equity REIT, why there might be an advantage for them going public, but a mortgage REIT, what the differences there.
Sure. So there were a couple of things when specifically it's a function of how this market has started, is that sale leaseback REITs, for instance, if we want to compare it to cannabis generally, have long duration leases, 15 to 20-year leases. And so when you have that kind of long duration, sometimes you can trade at a big premium to book. And so if you're on the right exchange and you have these long duration payments, there could be some imputed benefit to that, both from an access to capital basis, but also your book value goes up. Generally, the issue with mortgage REITs is that when you do a loan, you're only going to get paid back par at maturity. So you're only going to get par back at maturity. So there's limited upside to an increase in book value once you list on an exchange.
Great. Well, I appreciate you sharing that. And just to take a step back, the advantages of a REIT, just so and our investors know, or people know in general, are there's three primary advantages. One is that you get a 20% reduction in your federal tax rate. You only pay state taxes in the state that you're domiciled. And then on self-directed investments, there's no UBIT is cleansed on that structure. All right, so let's move on. Travis, we just came back from a couple of different conferences, and it's amazing how some of the percentage figures and the things that you know about the market in general. Why is the cannabis sector, why would that be less impacted than in a real estate or economic downturn? And I know that you've got some facts on comparisons of usage of alcohol to in cannabis, and some of those statistics that you've parked away in your brain.
Sure. So it's interesting. Cannabis is straddles a couple of categories, one of which, the medical category, but then two, it's often grouped in with kind of vice categories, say alcohol and other some other substances. And so ultimately what you typically see during a recessionary downturn is that alcohol consumption goes up, and some of these, quote unquote vice type industries tend to outperform. And there's a couple of reasons probably behind that. One of which, if people are stressed, it helps, alcohol and other things help take your mind off of that stress. So there's one element of that. And that's certainly what we saw during the last downturn, since it's been legal, which was COVID. COVID cannabis materially outperformed. And one of the things that it did was, one, it was deemed an essential business. So they were allowed to stay open throughout all of COVID. But then two, use went up. And so again, it was a different type of recession, short term in that nature. But it seems as though it will would perform similarly that way in another broader recession. The other thing at play here is you're just in a very high growth industry. So today, cannabis is about a $27 billion a year in legal sales. The total estimated cannabis market in sales, generally illegal plus legal, because we fortunately haven't got the illegal market out yet, is estimated to be somewhere between 80 and 100 billion. So you're talking about a third maybe of the market is in the legal market today. So that'll change as new states come online. For instance, Texas, one of the largest states in the country, has no real meaningful medical market to speak of. And they certainly don't have a recreation market. So you've got these big swaths of people that these new markets will come online we think will push sales. But away from just the entire country getting access and moving to the legal market, what you're starting to see is as cannabis becomes destigmatized, we've had 50 years of effectively negative advertising and stigma associated with cannabis. And so what you saw 4 years ago, when a recreational state would come online, roughly 17% of what they call the adult eligible population would consume once a month. Today, that number, the latest survey data that came out, puts that around 21%. So what you've seen is an uptick of almost 20% usage increase on a monthly basis. If you compare that to alcohol, Americans generally consume, 55% of Americans will consume one drink a month. And if you compare that to alcohol once a year, 95% of Americans will have one drink of alcohol per year. those numbers today in cannabis, like I said, are about, of the legal markets where it's legal, about 20% consume once a month, and about 37 to 40% consume once a year. So away from just the expansion of the available markets, we do think that there'll be an uptick in usage as it becomes less stigmatized, which should serve as strong tailwinds in any sort of recessionary environment, to kind of boost growth and to kind of limit the effect of a downturn.
So there's been some significant legislative and other announcements in the sector, and maybe I'll kind of talk on that. So one of them being safe banking was last week, was passed through the committee with a strong majority. And I think the first thing that people need to know what safe banking is, and it just basically is an amendment that basically says that banks cannot treat cannabis businesses any different than traditional businesses. And so this is a positive step. And I have, for the last several years that this has been moving through, I've said that getting through the Senate, the 60 votes necessary to be filibuster proof was going to be probably dead on arrival. But in this particular circumstance, I had a chance to meet with Steve Daines, the co-sponsor, about a month and a half ago, and he had told me that he had the votes to get it through. And what was different about this particular time was that the amendment was actually agreed to between the House and the Senate prior to pushing it through. And that's a significant difference here, because this particular time, if it passes the Senate, typically it has a different scope at the House when it passes the House, and then it has to be ratified after that. In this particular circumstance, I believe that it's going to be almost fully baked when it passes the Senate of what's going to pass on the House side. And I don't think that you would be seeing all the elected officials telegraphing in advance here that this is going to go through and they're looking forward to passing it. They wouldn't burn that political capital in making those statements if they didn't think it was going to go through. In politics, you don't take something to even a committee vote unless you know you've got the vote. So I'm actually fairly cautiously optimistic this time that safe banking will pass, but I don't think it's anywhere close to being as consequential as the other one, which is the rescheduling. Health and Human Services recommended to reschedule cannabis from Schedule 1 to Schedule 3. And just for the people listening, why that's so significant is that by moving it from Schedule 1 to Schedule 3, cannabis businesses, because cannabis is still federally legal, cannot deduct their expenses on their federal tax returns. And by moving from Schedule 1 to Schedule 3, that aspect, which was in the industry referred to as 280E, is the tax code of how it's codified, that they're going to be able to write off their expenses, and this is going to be a significant uplift to the bottom line on the federal tax returns. And additionally, they can carry forward the NOLs as well, which is, we could see some significant impact on this. So the way that works is the Health and Human Services makes the recommendation, and then the Department of Justice must provide a response. And I think that I've read that that's required in 90 days. We're coming up on that in probably another 30 days or so. But I think what is important to note is that if that they do recommend it, which I can't imagine that they wouldn't, because it's the DOJ is under the executive branch, and the directive from the president is to move this forward. I think that what's important to note here is that most likely we would get another a memo from the Department of Justice on how to treat this asset, similar to the Cole memo that was passed in the Obama administration, that gave, I believe it was 9 specific directives that if you follow these rules, it's basically, we won't prosecute you. And that gave the coverage for securities exchanges like Pershing's and other places that have custody of these assets to be able to hold these. And so I think that the combination of safe banking, rescheduling, and the Department of Justice memo could be just a massive uplift for the industry for 2024. So I just wanted to talk a little bit about that. Do you have anything to add on that, Travis, or how you think that might impact the cannabis industry as a whole?
I think it's massive. 280E is the biggest issue facing the cannabis industry. Short of a legalization event, the combination of a safe banking, some sort of memo, and a rescheduling doesn't get you everything you want, but maybe it gets you 60, 70% of what we would want. So we think it's a wholesale positive, and are very supportive of all of this, these developments.
That's great. There's other lending peers out there in the space of what we do, and maybe you could differentiate how we thought about lending in the sector as opposed to some of our peers that are able to do the same size and scale as us.
Yeah, sure. So it's interesting how the space has developed. It seems like a REIT was the best way to ultimately raise capital, and it started with, say, an IIPR doing sale leaseback REITs, which we think is an inferior for both investors as well as the ultimate sponsors. But because the kind of groundwork was laid around REITs, we think some people ultimately kind of jammed their lending model into the REIT structure in order to be successful in raising some capital. And so what's interesting to think, there's other people that call themselves mortgage REITs in this space, but there are very big differences between how we've structured loans and how they do. Now, everybody is a little bit of a hybrid in cannabis. So one of the things unique about cannabis real estate is the third-party ownership of real estate hasn't emerged in the space. So all of your borrowers are effectively owner users. They have a opco and a property company, so an operating company, a property company associated with each location. So we take a lien, or everybody in the space takes a first mortgage lien on the real estate, but we're also collateralized by the operating company, because you need to be able to secure the licenses so that if something were to go wrong, you can ultimately sell it to somebody else as a functioning cannabis facility. Our loans, in addition, have guarantees from either a parent company with some net worth and liquidity, or individuals with net worth and liquidity. And so I say that because there are lenders in this space that we typically have the same collateral package, but they lend more against it. So think about it as, if you've ever seen those, like the political spectrum graphs, where there's all the way to the left and there's all the way to the right, and everybody's somewhere in between. So if you think about it in this space, the pure real estate lending model is all the way to the left, and the pure corporate model is all the way to the other side. And everybody is somewhere in between on this spectrum. We're as close as you can be to the pure real estate lending model while being properly collateralized, where some of these other operators that are, use the mortgage REIT label, they're much more towards the corporate lending model. And so we'll take just the value of the real estate. Okay. We also take we're collateralized by the licenses, the opcos, the accounts receivable, we're collateralized by everything. But we think that those other sections of value are very volatile and hard to value in a new space. So we actually only look to the hard asset value when we size our loans. Some of our competitors will say, okay, I'll take the value of the real estate, I'll add in the value of the license, I'll add in the value of the accounts receivable, and we'll lend 60 to 70% of that stack, but that's 150, oftentimes 180% of the real estate value. So it's farther out the risk spectrum. And so what we've just seen repeatedly in markets, and some of our other peers, by the way, will say, oh, we don't go to unlimited license states. We only go to limited license states, which means that there's limited licenses issued. So you kind of have this oligarchy in some of these markets, which can be very good for bottom lines of some of these operators. But we don't think that long-term regime is sustainable. And so to give you an idea, state licenses in California, which is an unlimited license state, are probably worth about $150,000 a license. You can go to some limited license states, pick Pennsylvania, New Jersey, and those licenses may be worth $20 million. So we think that over time, states will be forced to issue more licenses, which we've seen at New Jersey, doubled the license count overnight. Pennsylvania is looking at more licenses, et cetera. So it should put downward pressure on the value of those licenses. And so we think, again, it won't necessarily happen overnight, but the value of the license are going to trend down towards the unlimited license type lower values. And so we just don't think that that's good to lend against that basis in today's market.
Thanks for that. And just to give people an idea of the size and scale of what we've done, Pelorus has originated 74 transactions for more than $500 million with 39 payoffs, which last I counted, I think it was 110 million. And we currently have about just under 420 million assets under management. Maybe you could talk a little bit about of our transactions in our portfolio. Numerous have equity kickers, and maybe you could explain what those options for warrants or what those are, and how those might be impacted as we see legislation, these things that we're discussing starting to free up, and how that might impact the fund.
Yeah, so if you haven't seen, cannabis equity values have been down for a variety of reasons over the last 18 months. I mean, effectively, we've been in a fairly negative news cycle around cannabis, catalyst. And two, the issue that a lot of the equities are having is, one, you can't really custody the shares. You can't, there's a lack of liquidity. There's no institutional support in these markets. In addition, because of the punitive taxes tied to 280E, and generally cost of capital in this space, there's not a lot of value left to the equity. So it kind of shifts the value from the equity to the debt side, which is where we are now. What we've been doing as prices have dropped on the equities, we've been doing deals, putting out capital and getting warrants and equity participations on these companies at these lower valuations. And so in a world where the 280E goes away, in the world where you can uplist, liquidity comes back into the space, there's a real upside to the value of these warrants that could ultimately be very accretive to investors. And to kind of frame that for you, to kind of think about, again, how this is all impacted, I was at an investor day with Cureleaf, and they were going through some of the metrics of the difference of pre, when things used to be, when the Cole memo was in place versus not. And one of the things they had, they said at the time we went public, and there used to be a memo in place called the Cole memo that gave the same protections we think a new memo might give when it comes out. And he said, we went public at a $4 billion valuation. We had 120 million in revenue. BlackRock was our biggest investor. All these big institutions were in it. We used to bank at Citibank. When the memo got pulled, they couldn't bank at Citibank anymore. All the custody of all the shares went away. Every institutional investor or forced sellers had to get out, and their stock price cratered. He says, today I have $1.2 billion in revenue, and I'm trading about a $3.5 billion valuation. So to kind of give you a sense of what it's done to valuations of the sector, this sector, the 280E headwinds, the lack of custody, all of these other things have been massive. So if those are all addressed, we would expect to see a big uptick in valuations of the equity. And you saw some of it already since the announcement was made in August. MSOS, which is the ETF that tracks U.S. cannabis operators, was up about 40% since August. So anyway, so we think there's a lot of positive catalysts. We we think that our return profile is based on the coupons and the loans and the lending that we're originating. But we do have these sweeteners that we've been able to negotiate and add in that we think will pay dividends over time.
Thanks for that. We've got a question here that if legalization, if we get some, anything that deconflicts state policy from federal policy that we discussed here a little bit earlier in the safe banking and rescheduling, how will this impact, or if cannabis, the prohibition is ended, how will this impact Pelorus? Is this a net benefit for Pelorus? How are we positioned to handle the competition and the things that might play out?
Yeah, so yes, we think it's a net positive for Pelorus. We think it's a net positive for the industry, and we think our business model is set up, and we've built it to outperform in both segments. And so part of the key to the strategy is in mortgage REITs. Mortgage REITs generally use a mix of equity and debt to fund themselves and then go out and make loans. And to give you an idea, we've been largely only equity funded up until towards the end of 2021, when we were the first to ever issue a corporate bond. We were also the first recently to ever issue a securitization, and we were the first about a year and a half ago to ever do a line of credit from an FDIC insured bank. And so these are three of the main routes. There are a few other routes that mortgage REITs typically use, but in each one of these situations, we've had to pay effectively a cannabis premium to access this debt capital market. So in every situation where non-cannabis issuers were able to issue maybe 300-400 basis points inside of where we had to issue, so our cost of capital has generally been higher. And so I say all this because in a world where it's deconflicted, our cost of debt capital goes down, and that we have access to the same tools that every other mortgage REIT has access to, and we are confident we can deliver the same return profile, 12 to 15%. We're just going to have a little different mix of equity and debt as we do it, and we think our cost of debt will go down.
Can you talk a little bit about how we think about the cannabis real estate sector and how in traditional real estate asset classes, the data that was out there and how you could do comps as opposed to the cannabis sector, and what we did to basically start analyzing this sector?
Sure. So with any new sector, there's the known unknowns and the unknown unknowns, and how do you kind of think about risk? And one of the things that real estate has, and why real estate, traditional CRE, it's a very as liquid as real estate can be. It's a relatively liquid market, and part of the reason cap rates compressed over time, it's not just that rates drop. There was a lot of there was a information symmetry that was provided by a lot of these large data companies, one of which being CoStar, the other one being REITs, and then there's another one called Real Capital Analytics. And so they basically took rental data, sale data, and put it in easily accessible databases and websites that you could come and track historical sales trends, real estate values, ups and downs, where rents are getting done, where cap rates are done, et cetera. And so it provided a better view into the market and ultimately increased the liquidity in that market. And so one of the things, I used to work at a large hedge fund, and we had a whole team of probably 10 quants, and I used to trade commercial mortgage-backed securities, so CMBS, and it's a $500 billion market of total issuance outstanding. And we would buy data feeds from all these data providers, and we would use that to basically come up with credit, default, and loss models, and better understand the risks and values associated on the underlying assets, et cetera. None of those, and I saw the power of what it can do, that none of those services tracked cannabis data. And so we had to ultimately go out and get it. So what we did was we founded a separate data company, and we have a best-in-class data team, and we're scraping data from over 100 different sources on a monthly basis. And so in some cases, we're the sole source, and it's interesting, every state is slightly different, but in some cases, we're the sole source of historical data because the state may only publish a snapshot in time, and they don't even publish time series data. So it's very valuable in helping us understand it. To give you guys an idea, when we first went out to see what kind of data we can get and find, the state of California was where we started. The state of California publishes license data, but one of the things they don't do is publish addresses for cultivation or manufacturing facilities for security reasons. And so if, as a real estate focused lender, we want to know where these facilities are at. We want to know how many exist. We want to know, who owns them, et cetera. So we were able to use alternative data, and we were able to map every single facility in the state of California. We know whether it's a greenhouse, we know whether it's indoor, we know who owns it, we know how many square feet they can grow, et cetera. And we can see clusterings of where they sit. So again, that was one of the very first insights we achieved. It's gotten significantly more complex. It's always a work in progress as we think of new ideas and what else we want to try to understand. But we're the only ones in the space currently doing this.
Thanks for sharing that. And due to the specialty use nature of these facilities, in that we not only lend to the propco, the borrower, but also tie up the licenses as you discussed when we were talking about how the collateral we take. Can you walk us through how if the highest and best use is cannabis, and if we have that license, how we would think about repositioning an asset in the event that we have to take one back, and how we think about that given the specialty use nature of it?
Yeah, so one, we want to better, each market functions differently. And for those who may or may not know, cannabis today cannot be shipped over state lines. So each individual state, you have to cultivate, manufacture, distribute, and sell within your state in a legal market. So it creates, and each state licenses things slightly differently. Some are very comparable, some are actually very, very different. And so we want to understand the supply and demand dynamics in each individual state when we lend, but also if something were to default and how we would deal with it. Depending on which state it is and why it defaulted, there may be an active market ready to sell the asset to somebody. In a situation where it is not stabilized mid-construction, because we do a lot of construction loans, and what we need to do is ultimately stabilize the asset, get it operational, and then ultimately sell to somebody else that's a cannabis operator. And so depending on the state of the asset, depending on the state of the market, drives that decision tree. But you know, this is a specialty use asset. We think of it very similar as other asset classes that launched that were poorly understood at the time and now are a very accepted asset class, like cold storage, lab space, and data centers. All are highly specialized use assets with significant demand from those types of users. So but when they first came to market, people didn't know how to think about it. And I remember cold storage, you know, it doesn't have a traditional NOI when you think of it as it comes to real estate. They pay rent by pallet, not by square foot. There's all of these different things. So investors originally priced all these loans wide because they didn't know. They needed to see track record. They needed to see these things. And it turns out that they've actually significantly outperformed in these situations. And frankly, nobody's ever asked, well, what happens if you convert a cold storage into multifamily or something else, what the value would be. It has significant value as it stands, as it sits today. And that's generally how these specialty use asset markets work.
Appreciate it. This is a question. Can you share with us how we think about our construction loans and our fully stabilized, and if a construction loan borrower is not able to qualify for a traditional takeout, how we think about those loans and granting extensions, or how we would be thinking about moving them to our fully stabilized product?
Yeah, so if you're a good borrower, you're executing, you're doing what you say you were going to do, these are relationships that we want to foster and grow throughout the industry growth life cycle. And so we don't want those guys to leave our books. We do one of the reasons we launched the whole stabilized lending program was that we found we were taking all the construction risk, and then when it was cash flowing and stabilized, we would ultimately lose them to another lender that could offer a cheaper rate. And so we wanted to launch a product that was a cheaper rate to keep good borrowers in our system. And so how we think about it is ultimately we want to see some proven track record, some proven cash flow and growth, and that you're actually hitting your numbers and your projections to qualify for the stabilized lending. So if it's a good borrower, we have some leeway. Obviously, the credit committee can decide when they might qualify and when they might not, or when we want to wait and see it. But those are the key differences.
You know, I get this question a lot. You know, where do we see our firm in the next 2 to 3 years? You know, how are we going to compete against banks directly? How is it even possible to do that? And maybe you could talk a little bit about our strategy there.
Yeah, it's really when it becomes more competitive, you know, we're going to have access to the same tools, and we've been working very hard to set those tools up to allow us to compete. And those are being the securitizations, the corporate bonds, the lines of credit, these other instruments. I mean, to give you a sense, you know, I like to use this as an extreme example, but think of multifamily rental apartments. It's a unique market if you know how the debt is originated and ultimately lent in the space, where Fannie and Freddie Mac, which are quasi or actually fully owned, effectively government entities, they own that market. So they do 95% of every loan done every year is done by Fannie and Freddie. So there people are competing. And I use this because it's so extreme and the market share is so disproportionate to one person, and you're competing with the government. There's still room for a REIT called Arbor Commercial REIT. They're about a $3-4 billion REIT, and they do focus almost exclusively on multifamily lending. And so they've still found the right mix of equity and debt. They've still found takers of that capital, and they still have investors happy with their dividend yield. And so if that can happen in such an extreme situation, there's no reason we can't do the same thing. There's always non-bank lenders competing with banks. And that's frankly, the shift to private credit has exacerbated that. So anyway, we expect there to be a space for us.
Thanks for sharing. We covered a lot of things here. We've answered the questions that came through. If there's questions that anybody has that would like to follow up with us, or if you'd like more information on the Pelorus Fund, you can contact us at IR for Investor Relations at peloruscg.com. And we'll send out this recorded webinar to everybody that registered for this as well. Travis, thank you so much for being here, and everybody that's in our webinar. We appreciate you listening to us, and we'll try to come out with these every so often to give some updates. So thank you for everybody for your time. Bye.
Thanks, everyone.